David and I want to welcome you again for another one of our educational videos. We're glad you can join us. Today we're going to talk about our three-ball strategy and also asset allocation and how those two things fit together. One of the things that David and I are always trying to do is balance off the risk that you have in your portfolio and also the return that you want. And we're going to show you our three-ball strategy and show you how we make that work for you.
When it comes to investing, timeline is by far the most important thing. And a common adage or an old adage in the investment circles is it's time in the market, not timing the markets, which determines your long-term success. In other words, if you hold on to a good investment for a long period of time, you'll do well. Investing by its nature is complicated, but in today's video, we're going to seek to try and simplify it with our three-ball strategy. Hope you enjoy.
The first ball is suitable for any money you have saved that you plan to spend within 3 years. The first ball is cash and cash equivalents. Cash and cash equivalents consist of things like high-interest savings accounts, GICs, or term deposits, and money market funds. The return potential on cash and cash equivalents is minimal, but they have a very high level of safety. Your money will grow with interest when you invest in assets in the first ball. In today's low interest rate environment, you are likely to only earn 1 to 2% in this ball. So the rate of growth is certainly not high, but it provides a high level of safety. The prospect of not losing money and retaining liquidity is more appealing than the rate of return in this asset class.
The second ball is suitable for any money you plan to spend between 4 to 7 years from now. The second ball is fixed income. Fixed income is an asset class that pays an interest rate just like the first ball. Fixed income may also be referred to as bonds. Bonds are a financial instrument of indebtedness. It is common for a government or corporation to issue debt in the form of a bond. The holder of the bond becomes a creditor of the issuer of the bond, and the holder of a bond will receive payment of interest plus repayment of principal at a set date in the future. While bonds do have an interest rate just like a savings account or a term deposit, they are also complicated by the fact that they can be traded after purchase. Unlike a GIC from the bank where you are locked in for a period with no access to your principal, there is a market for bonds to be traded by investors after purchase. And based on how interest rates are trending and other factors like liquidity and credit quality, among other things, a bond's value can fluctuate. There are many different types of bonds for investors to choose from. There are government bonds, corporate bonds, floating rate bonds, mortgage-backed bonds, convertible bonds, and more. Bonds that are issued by governments are typically less risky than bonds issued by a company. Less risky bonds typically carry lower interest rates compared to more risky bonds. However, in a diversified portfolio of fixed income or bonds, you can generally expect to average between 3 and 6%. With interest rates at historical lows currently, we are closer to the lower end of that average return expectation. Like we said, bond prices can fluctuate with interest rate movements and other factors, and so there is a moderate degree of volatility and risk that an investor must consider when investing in a diversified bond fund. In a good year, a diversified bond portfolio might go up 15%, but in a poor year it could drop 10%. Therefore, we recommend bonds for money you have 4 years or longer to invest before you need to spend that money.
The third ball is suitable for any money you do not need to spend in the next 7 years or longer. The third ball is stocks. Stocks is a capital raised by businesses or corporations through the issuance of shares. Companies typically issue shares as a method to raise money so that they can improve their business by spending the money raised on things like more employees, or to manufacture a new product, or to acquire a competing business, just to name a few examples. Stocks are also commonly referred to as shares or equities. Investing in stock carries more risk than investing in fixed income or cash equivalents. The potential rewards are also higher. Because there is more risk with investing in stocks, we typically recommend that you only invest in this asset class if you have 7 years or longer before you expect to need to spend the money you've invested. In any given year, if you are invested in a fund that owns a diversified portfolio of stocks, you should expect that your investment could grow up to 40% in a good year. Conversely, in a poor year, your investments could drop upwards of 30%. Of course, if you are only invested in one stock rather than a fund that owns a diversified portfolio of stocks, your potential upside is higher but the risks are also much greater. This is called concentration risk if you are not well diversified. If you can remain invested in a diversified portfolio of stocks for 7 years or longer, you should expect to grow your portfolio between 7 to 10% on average over time.
Now we will show you an example of how the 3-ball strategy works. Let's say for an example that you have $1 million to invest and you'd like to take an income of $50,000 a year from your investment portfolio. Based on the 3-ball strategy, we need to account for your short-term income needs. And so we would recommend investing 3 years worth of income in the first ball. 3 years multiplied by a $50,000 per year income need means we should allocate $150,000 to cash or cash equivalents. Applying the same logic, we recommend that any money you may need to spend from 4 to 7 years from now should be invested in fixed income or bond funds. So 4 years multiplied by a $50,000 per year income need means we should allocate $200,000 to fixed income. By doing so, we have invested the next 7 years' worth of income in interest-bearing and relatively conservative investments. This means that the remaining $650,000 could be invested in the third ball, which is stocks. The idea with this asset allocation strategy is that if we have a good year with stocks, we simply take the $50,000 income and rebalance the portfolio to ensure 7 years' worth of income remains protected. If we have a poor year in the stock market, you can still take an income of $50,000 from the portfolio, but rather than selling stock investment funds when the price is depressed in order to rebalance, we won't touch the stock portion of the portfolio, knowing it will recover with time. During a temporary market sell-off, we can take solace in the fact that we have 3 years' worth of income needs allocated to the first ball and 4 more years' worth of income needs allocated to the second ball. This gives us 7 years for the stock funds in our portfolio to recover from a market sell-off and get back to earning the 7 to 10% average returns we expect from this asset class. History has proven that 7 years is ample time for a recovery to take place in the stock markets. In 2008, the stock markets recouped their losses in a little over 3 years, and within the next 3 years after that, stocks had once again provided a good rate of return for investors who remained invested from 2008 through 2014. This graphic illustrates the logic behind our 3-ball strategy. At the end of the day, when our clients give us money to invest on their behalf, we want to make sure that they end up with a good positive return when they withdraw that money in the future in order to spend it. Therefore, we always ask clients what the purpose of their money is and when they think they may need to spend it. As this graphic shows, the odds of obtaining a positive return when investing in Canadian stocks for a 12-month period is about 75%. Conversely, the chances of obtaining a negative return is about 25%. As you lengthen the amount of time you are invested in Canadian stocks, the chances of a positive return increases and the chances of a negative return decreases. If you remain invested for 5 years in Canadian stocks, your chances of positive return historically have been 98%, and your chances of a negative return has only been about 2%. The point being is that if you're investing in stocks, the shorter the amount of time you're willing to invest, the lower your chances are of obtaining a positive return. The longer you are willing to invest, the chances of a positive return are greatly improved. If you're willing to invest in a diversified portfolio of stocks for longer than 7 years, there is a low risk of a total negative return for that period, and the odds of obtaining a positive return are very high.
David and I want to thank you again for joining us in another one of our educational videos. The 3-ball strategy, it's just a guide. It's not going to 100% fit with everyone because some people are far more growth oriented than others. We have some clients that the only thing they want to do is invest in fixed income, and others the only thing they want to do is fixing in growth. But overall, it's a fantastic strategy and we know you're going to find it useful.
At the end of the day, like Harry said, it is a guide, and what we seek to do is to do a financial plan for you, do an investment policy statement, and create a custom tailored portfolio for what it is that you want to achieve. You may have a target rate of return in mind, or you may want to limit risk in your portfolio. So we can take those things into consideration and design a portfolio that you're happy with. If you'd like to review your portfolio, we'd be happy to hear from you.
Take care.